All right. So before starting today's class, just give me 10 to 15 seconds just to recap of what we have done already, what was within the previous lecture. Within the previous lecture, we did a very important question of a past paper known as Magpie Corporation. Now, why is Magpie Corporation important? Because it is not that much of a technical question. It is not that much of a difficult question, although there is some difficulty in understanding that question. But that is like you can say 99% difficulty that you are going to face within the exam. If you are able to understand that question, then rest of the questions are easier to understand for you, because Magpie is, I think, one of very technical questions that there is within the exam kit as well. Just goes the same for this next question that we will be attempting today. And remember, Mac Corporation, and right after that is it is the next question, ESK Corporation. Whenever any student is studying F8 for me, F8 from me, and I have to go over the questions of past exams, whenever my first priority is always Magpie Corporation, and the second question that I always do is ESK Corporation, since these questions have come out after their exams attempts. So these two exams, yes, yes.
Can you tell me what questions to do like for practice? Because I can't do all of them. It was like 19 questions.
Yeah, so you have to do every single question, by the way. So
Every
there is
single
no,
one.
yes, F8 is all about practice, by the way. Just remember that. Please don't forget this thing that I told you repeatedly again and again within all the previous lectures, even within ethics, even when I was giving an introduction of the audit. There are only two ways to pass F8, and you have to do both of them. Number one, practice. Practice a lot. As much questions you can practice, they are less. You can do like 100 questions if they are given to you. I will still say that they are less. Questions as many, practice as many questions as you can. Number one reason, if you want to pass. Number two step, if you want to pass. All the questions that you do must be shared with your tutor, and they must be reviewed by your tutor, and a response also must be given by the tutor. If the response is, if your questions are correct, if your answers are correct, obviously the tutor will say your approach is correct. He is not going to ask you to change your approach. If you are doing something wrong, the tutor is going to tell you your approach is wrong at the moment. Please change it. You are doing something wrong. And then you practice with the right approach and you become more good towards the examination. Got it? So you have to practice a lot, because first of all, it is a theoretical exam. So you have to do that. There is no other way. So
Okay.
Magpie Corporation, we are done with it. I gave you, I remember, 4 risks to write down as a homework, which I identified from within the analytical procedures. And then before that, I gave 2 paragraphs as a homework as well, which I have received as a homework, and I've checked it, and I've given you a response that they are correct. Now let's move towards the next question, which we are going to attempt. And the name of the question is ESK Corporation, equally important just as Magpie Corporation, which is why I'm moving towards this question. Let's read before reading the question. I've told you always go towards the requirement and check out what does the requirement say, because if you are reading the question first of all and then you go towards the requirement and you find out there was a requirement that was completely theoretical, which was not linked with the scenario, you have wasted your time. You could have done that within just 2 minutes. So let's look at requirement number A. What does it state? Describe the preconditions for an audit that Bannock and Corporation should have established prior to accepting the audit. We have already done this question where we were discussing the preconditions for the audit, which you need to have before accepting the client. We have already done it in the ethics chapter. So this is something that is very easy. You just have to learn that part and write it down right here. There were 3 preconditions for an audit. You need to remember what they were for 4 marks. We have done that already. Great. Now let's come towards part B. Because again, look, it only has 4 marks. So what is the part B requiring? Using the table below, calculate the 4 ratios for both here to assist you in the planning of the audit of S Corporation. So I have to calculate the following ratios. Are these ratios difficult to calculate? The number 1 ratio is gross profit margin. Let's look at the GPM first of all. Please calculate it with me. The gross profit is 8.4 for 2015 and the revenue is 30.9. So what is going to be my calculation? 8.4 divided by 30.9 multiplied by 100. Let's do that calculation. Hurry up.
Are you doing it or should I do it?
You should, I'm doing it, but you should also do it, by the way, just
Like,
to
give me the
make sure
calculator
that you are
in
aligned with
your
me.
wardrobe.
Maybe I'm doing
Okay,
something wrong. So my answer comes for 2015, it is 27.1% or 27% as a whole. Whatever I write, it does not matter. My answer should be correct. That's it. So for 2014, 7.6 divided by 27.5 multiplied by, I did the wrong calculation. 7.6 divided by 27.
7.6 divided by 27.5 times 100.
27.6%, right?
Yep.
So my answer is
7
27.6.
point.
So I can clearly see that the gross profit margin is not changing by a lot. It is almost the same. There is just decimal points difference in it. So still, I'll go back and take a look at the revenue, like what is happening there within the cost of sales, because I can see that the revenue is increasing and the cost of sales is also increasing. But are they increasing within the same ratio or not? Can I make a risk here or not? I'll see that later on. But let's calculate the first of all the ratios that are required within the exam, because they are for 4 marks. So the next ratio I have to calculate is inventory holding period. Let's go towards the financials which have been given to me. Do I have inventory balance? Yes, I have it. Do I have the cost of sales? Yes, I have it. So 8 point,
Inventory over cost of sales times
yes,
365.
8.3 divided by 22.5 multiplied by 365 is equal to 134 days. Okay, inventory is very high, by the way. Let's look at what is happening within the previous year. Because if there is a significant increase, then there is an issue. If there is no significant increase, this means that the company operates in such industry where inventory is held for so long period and there is no issue in that. So let's look at the previous year's inventory. It was 6.4 divided by what was the previous year's cost of sales? It was 19.9. 19.9 multiplied by 365 is equal. Oh, my answer is wrong. Wait a second. It was 6.4 divided by 19.9 multiplied by 365 is equal to 117 days. So if I look at the inventory days as well, they have also not increased significantly yet, but only by, let's say, 10, 17, 27. Okay, almost by 20 days the inventory holding period has increased. So the risk, I'm not going to say that the risk is very high. There is still a risk that the inventory might be becoming obsolete, but still,
Oh, really?
yes, not really. There is not such a high risk right now. So yes, back at the mind, I have this point at the moment. If I'm not able to identify enough risks within the question, I am going to use this as a last resort, because I know that maybe the examiner won't give me marks for it. So yes, it can be a last resort, but surely I'm not going to write it down at first. First, I will need to complete all the required risks from within the scenario. If I'm able to complete that, I will ignore it. But the examiner has required this calculation, so I'm calculating it. Let's move towards the next one. What is the next one? Receivable collection period. Let's calculate it. What is the receivable collection period? Let's move towards the receivable. The receivables are 7.2 divided by revenue 30.9. 7.2 divided by 30.9 multiplied by 365. The receivable days in the current year are, what is the receivable days? 85 days. 85 days. Let's look at the previous year. What were the receivable days in the previous year? Let's look at that. The receivable were 4.9 divided by 27.5. That was the revenue multiplied by 365. Let's do this calculation. 4.9 divided by 27.5 multiplied by 365. So, oh, okay. Now here is a risk. The receivable days have increased from 65 days to 85 days. Again, yes, there is a very small risk here because the receivable days are increasing by how many days? 65 to 85. Even though the receivable days were really high in the previous year as well, they are still high in the current year. The increase is only for 20 days. So yes, there is still a risk, but and I can also write down about it, because for receivable days, if they are increasing by more than 10 days, 10 days, always write it down. Because again, your receivable are taking more. They are increasing by, let's say, from one bracket to another bracket. We either the receivable will pay you after 60 days, or either the receivable is going to pay you after 90 days. So the bracket is increasing here. So I can create a sort of risk. But again, this is not going to be my first option. Let's move towards the payable payment period. Maybe I will be able to find something here as well. Where is the financials? I have the financials here. So the trade payables were 2.4, and compare it with cost of sales. Let's write it down. 2.4 divided by 22.5 multiplied by 365 and 38 days. Current payment period is 38 days. All right. Let's move towards 2014. What was the answer for 2014? 3.5. 3.5 divided by what was the cost of sales? 19.9 multiplied by 365 is equal to 64 days. So now I think that there is a risk just by looking at this, just by taking a look at this. The payable payment period is decreasing, right? It is taking me less days to pay my payables back. Why is it taking me less days? How have I made this calculation? By taking the payables balance as within my calculation. So I know that the payables balance is decreasing at the moment. Whenever the payable balance is decreasing by too much, this creates a risk that management may have under recorded the trade payables because the balance is decreasing by too much. Therefore, the payable days are also decreasing.
Wait,
Maybe to
come
show
again.
less liability. Yes, come again.
I didn't get what you said for that one, the payable part.
I'm sorry, come again. Please ask me the question
I
again.
didn't understand the payable part. Could you explain what you
Okay,
mean?
I'll repeat it again. Why is the payable days decreasing? One way to explain it is that I'm taking less days to pay my payables. So I'm paying my suppliers really fast in the current year. That is one way to describe it. The other way to describe is that my payables balance is decreasing at the same time. That is why my payables payment period is also decreasing. Understandable? Any questions up till this point?
No, no.
No. Great.
So what's
So
the risk?
when in the previous period, now if I look at the balance, even if I don't look at the balance, let's just leave that. If I try to use my mind, I know that the payable payment period has decreased just because of the fact that my total payables balance has decreased by too much. That is why the payment period has also decreased by a significant number of days. So in other way, if I want to explain it, I can also say maybe the company has under recorded or understated their trade payables balance to show a less liability position within their financial statements. This can also be a risk, but again, it is not a major risk. I'm not going to directly move towards it at the moment. I'll first try to look at the risk which I identify from the story, because again, all the risks that I have identified from these specific calculations are not that much huge risks. So first, I should prioritize moving towards the other types of risks that I identify. Any questions?
No.
Still, let's move towards part C.
Right.
What does the part C say? Using the information provided and the ratios calculated, blah, 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 describe 8 audit risks. So I have to simply identify 8 different audit risks and provide a response against each of the risks. So my question is pretty much done. Why? Because now I just need to see the story, identify the risks, and write down about them using the 3 points that I have written you down within the notes of how to write down an audit risk, and at the same time how to write the response properly. So let's look at the story. What does it say? Let's take a look at it. It is 1st of July 2015. You are an audit supervisor with Bannock and Corporation. So basically, this is the name of my audit firm in which I am an audit supervisor. This is an imagination that the examiner is generating within my mind, and are responsible for planning the audit of a new client. I think we just got
Okay,
to.
do I have to write in first person or it doesn't matter?
Sorry, come again.
Do I have to write in first person or it doesn't matter? Like, do I have to say, like, when I'm answering, I say we identified the risk or we did this, or can I just say the auditors identified this risk?
Yes, exactly. I don't need to write the risk down that we already have identified within the previous question as well. So that is
No,
a
no, no. What I'm
repetitive.
saying, no. What I'm saying is, do I have to like talk as in, we identified this,
Yes.
we think the
No,
management
no,
do I
no.
have to say the
No.
auditors did this? You know what I
There
mean?
is a specific way in which I have given you the criteria of how you write it down. Like the first point is there is a risk. You don't say I, you don't say we identified. You don't say the firm has identified. You only write down that there is a risk that this balance is overstated and this balance is understated within this financial statements. And then you go on with your explanation and why you think that there is a risk. Got it? You can use, it is better to use third language, that is we would be a better option when you are providing an explanation in the point number 3 that why I think that there is a risk. Got it?
Yeah.
Great. So reading the first line, I think we just got 2 marks, free 2 marks, which was responsible for the planning of an audit of new client. So it is a new client. Simply, I have to repeat the same type of risk that we have already done within Magpie Corporation. What was the risk? What is the explanation for it? So basically, we have identified the first risk right here of new client. What was the risk? The risk was very simple.
Sure, talk
There,
about it. Oh, yes, we-
there
sure.
is a risk that the auditor will not be able to detect the misstatements within the financial statements. Now, in point number two, we had to write down about the standard. There is no standard link with it. We will simply ignore this point. Let's move towards point number three. Why do I think that there is a risk? The above risk exists because the auditor does not have cumulative knowledge about this new audit client, and at the same time, there is another risk that the previous year's closing balances may not be matching with the opening balances of the current year because we were not the auditors of this company for the previous years, and the company may try to misstate them deliberately. Got it? So explanation is again the same thing, only the words are a bit different right now. I am explaining the same thing right now. What is going to be the response? The same response that we gave within the question of Magpie Corporation. What was the response there? Simple. The auditor should be more professionally skeptic and test more samples to make sure that the test is performed in detail and to make sure that the risk is covered. Additionally, the auditor should also make sure the audit team should also make sure that they ask the management to provide them the audited financial statements of the previous year and compare the closing balances of the previous year's financial statements with the opening balances of the current year's financial statement. That's it. Simple. This is known as repetitions of risk, and you will see it again and again and again in every single question that you attempt. Got it? So the
Yeah, that's
first risk, I am not going to write it down because we have already done it. It is very easy to understand. Let's move forwards now. S Corporation is the name of the company. For the year ending 31st of July 2015, this is the year, this is basically the year end of this company on which they make the financial statements. Your audit manager recently met with the finance director of S Corporation and has provided you with the following planning meeting notes and financial statements extracts. So we have already looked at the financial statements. Let's look at the stories. In this paragraph, we are going to receive the introduction of this company. Obviously, I told you in the previous lecture, previous question as well, which we were attempting. S Corporation is a manufacturer and wholesaler of plumbing supplies. Great, we know what is plumbing supplies. It operates from two warehouses which are suited in the north and south of the country. Great. Extracts from the forecast financial statements for the year ending 31st August 2015 and the final financial statements for 2014 are as follows. So basically, the examiner is saying this is the previous year's financial statement, this is the current year's financial statement. Do not ask the question,
oh,
do
because
not
what
get
is
confused.
forecast?
Don't get confused what is meant by forecasted financial statement. Don't get confused what is meant by the final financial statement. Simply, 2014 was the previous year and the current year is 2015. The new year is obviously which we are auditing right now. Don't get confused in any other thing. Got it? So let's move forwards within the story. In September 2014, S Corporation purchased a patent for 2.6 million, which gives it the exclusive right to manufacture a waste disposal system for a period of 4 years. So basically, when you purchase a patent, it is we know and we have studied this within F7 as well, within F3 as well, that when you purchase a license to do something, that license is going to
It's
generate
an intangible
economic
asset.
benefits for you over its life, for how
Mhm.
many years you are going to use that license. So that license is now becoming an asset. And what type of an asset? Because that asset is going to provide you, that
Intangible.
license is going to provide you economic benefits for more than 12 months. Hence, that asset is known as an intangible asset. So instead of calling this a patent, I'm going to simply keep in my mind that this is an intangible asset that the company has purchased. So let's read it forwards. Is there a risk up till now? Let's see. The purchase cost capitalized compromises the cost of the patent and other costs such as legal fee and administrative cost incurring in negotiating the contract.
Should
Hmm.
administrative costs be capitalized? I don't
Come
think
again,
so.
please.
Should administrative costs be capitalized?
It
Negotiate.
cannot be capitalized. You have the right answer
Yeah.
there. So I'm simply going to write down that there is a risk. I know now if I write down right now, just let me know. If I write down that there is a risk, I'm creating a chance or I'm saying that there might be a risk. But I know it is not a risk. The management has done it wrong. They should have only capitalized the cost of the patent and ignore the legal fees and administrative cost and all those things because they cannot be capitalized. They are expenses. They should have been expense. So the $2.6 million which has been capitalized includes these two costs as well. Instead of writing down that there is a risk, I'm going to write down the Instead of writing down there is a risk, I will simply write down the intangible assets within the statement of financial position are overstated, and the administration expenses and other costs which has been capitalized by the management, those expenses should have been recorded within the statement of profit and loss, which have not been done so. Hence, they are understated. So that is going to be my opening answer. So how am I going to write down? Let me make up the table first of all. Just give me 1 second. Let me insert the table. A 2 by 2 table. Which question am I attempting at the moment? I am attempting S corporation. And
I
which
have a
part am I
question.
attempting? I am attempting part number C. Great. Now let's move towards the answer. I'm going to give the heading of audit risk. And on the other point, I'm going to write down responses. That's it. And I'm going to move towards the next tab and going to come back towards the previous tab and make it bold so that the examiner finds it a bit professional. So I have already written and identified the first risk, which was of the new client. I'm not going to write it down. I'm just writing it down here so you remember it. So you will have to write it down. Let's move towards the second number risk. What was the second number risk? The intangible. So many of the students are going to mistake the here. Instead of stating that the intangible assets are overstated, they would state that the patent is overstated. No. What is a patent? It is an intangible asset. Within the statement of financial position, the name of the patent is not
So
like
I don't say that's risk.
2.6 billion. It is written intangible assets 2.6 billion. So I will use the appropriate name.
Sorry, you don't say there's risk.
There is not a risk. I know that it has been done wrong. It is
So you
written
just
within the
say
question that the management has capitalized the administrative cost. So there is not a risk here. The management has done it wrong. I can clearly see it. There would be a risk somewhere where I am like 50-50. But in this case,
so it has a risk.
obviously the cost capitalized of administrative cost, it was not supposed to be in that way. So management has done it wrong. So instead of stating that there is a risk, I will simply write down the management has done it wrong. Got it?
Okay. Yeah.
Great. Let's move back. The intangible assets within the statement of financial position are overstated, and the relevant expenses in statement of profit and loss are understated because they have been not recorded by the management. What does the standard say about it? I know that there is a line within IS 38 which states that only the cost which will give you a benefit over the patent's life, only that can be capitalized. Other cost, indirect cost that has been incurred to acquire that patent cannot be capitalized. So my simple explanation would be accounting standards state that indirect cost cannot be capitalized in the cost of patent. Now, my third point has to be, why do I think that this is the case? Simply whatever explanation was given to me within the question. Obviously, I'm not saying that there is a risk. I know something has been done wrong. So what has been done wrong? I'll simply write it down. I will write down the management has capitalized the administrative and other costs which are indirect expenses and have to be expensed within the statement of profit and loss instead of being capitalized, which the management has done. Hence, the above, hence the assets, hence the intangible assets are overstated. And obviously, I'm not going to provide the next explanation. I can also do that. Hence, the irrelevant expenses are understated. So let's come towards my response. What is going to be the response in this case? What is going to be the response in this case? The management has already done it. They have overstated their intangible assets. So I'm not going to tell my
Tell management to change it.
No, I'm not simply going to state that. Obviously, be professional. Don't be direct with the management. Don't tell them you have done it wrong, correct it. No, you need to provide an evidence to the management as well. You have done it wrong. So I will let my team know that tell the management again to provide you a breakup of the administrative cost and take a look at the invoices and show the management of these invoices and let them know that these are indirect costs and discuss with management that these should be expensed out and not capitalized. That would be my appropriate approach to this answer. I have to be a professional person. I have to provide the evidence to the manager as well, that management as well, that why you have to write it down. And why would they have to write it down? They needed evidence. Where would they get an evidence? Again, I will have to show them from the invoice that look at this expense. This is an indirect expense. Got it? So my response would be the audit team should first ask the management to provide a breakup of the indirect cost capitalized, and then on a sample basis, again, the auditor does every single thing on a sample basis. But okay, no, the sample basis would be a confusing here, so leave it on, and then discuss with management that these indirect costs cannot be capitalized, rather expensed. That's it. That is all that I will let my audit team know, that this is how you should approach this. That's it. Got it? Let's move towards the next part where we left it from. We have audited in how many marks? By the way, how many risks have been covered up by us? 2. We are only supposed to write down 8. Let's move forwards. In order to finance this purchase, all right, they had to, I think, take out a loan to be able to buy this license. Let's read what is the examiner stating. S Corporation obtained an interest-bearing bank loan of 2.5 million during the year. The bank loan is payable in 5 equal annual installments, with the first installment due to be paid on 1st of September 2015. Okay.
Well, maybe there's risk that the loan is not properly accounted for.
Let's move towards the notes that I gave you, the hack that I provided. What was the hack, by the way? Let's see. Does it talk about loan?
But I also saw a loan covenant.
Now, loan covenant is something else. When you find out that the company may be breaking loan covenants, then you write down this kind of risk. You can't just pick up a risk and write it down. I'm going to let
Let's say
you
the
know.
loan is not accounted correctly. I think that's the risk.
Yes, that can also be correct. But let's look at the scenario. Have I included it here or not? Let's take a look at it. Give me 1 second. Maybe yes, maybe not. Even if not, we are going to do it today, so it will be easier for you to write this down within the next questions as well.
That the
So,
cost inventory should be
within your
updated.
accounting system, bespoke issue of equity and loan here. So basically, what
I
happens
have
is
a question
that,
after this.
yes, what happens is that whenever a new loan is taken out or the company is issuing its shares, there is a breakup. What is the breakup? Some of the loan has to be classified as a non-current liability, and some of the loan has to be classified as a current liability, right? Yes.
Okay.
And again, you will also learn this, that there are disclosure notes, and when you are taking out a loan, you have to provide some disclosures within your financial statements as well. So overall, whenever you find out that the company in the question, you find out that either the company is issuing a loan or taking out a loan. Sorry, issuing a loan also means that taking out a loan, or they are issuing their equity. You always simply write down this risk, that there is a risk that the non-current liabilities and the current liability classification is done incorrectly, and there is also a risk that the disclosures may not be correct. So I'm going to explain it and write it down simply as well. My answer would be, give me 1 second, please. I'm going to come to the next tab and write down my third number of risk. My third number of risk would be, there is a risk that the current and non-current breakup of the new loan is not done appropriately, and that the disclosure requirements may also have not been fulfilled. So we know that there is an accounting standard. Obviously, the accounting standard have told us that a loan has to be broken down into current liability and non-current portion, and they both have to be classified appropriately. And then the accounting standard also states that there are some disclosures.
What current
But I'm going to say, you have not studied that accounting standard.
what disclosure requirement?
Leave it. You have not studied that accounting standard at the moment. Just remember, when you are taking out a new loan or you are issuing equity, You know that there is a fifth type of financial statements which is known as disclosure notes, right? In those disclosure notes, you have to provide some theoretical information to the users of the financial statement. In the financial statements, you provide all the numbers, and then based upon those numbers, you have to write things down within the disclosure notes, within the financial statements, like how we calculated this, how we did this, what is the interest on this loan, what is the percentage of interest on this loan. These have to be written down in writing, and then the users of the financial statements can read them. Maybe those disclosures are not correct. Just remember that. Got it?
Yeah.
Great. Now, I know that although you haven't studied this I know that you have not studied this accounting standard within F7 in detail, and the examiner of F8 is going to expect the same from you. So in case of equity and loan, you can ignore any kind of second step and directly move towards the third step. Why do you think that there is this risk?
Equity, I should always write, if they issue equity, that there's risk that they're not correctly divided between premium and like the normal thing. What's it called?
The share capital and
And share premium.
share premium.
Do they have to disclose it?
Yes, it also has disclosures.
Oh, okay.
Okay. So why do I think that there is risk? This risk exists. A very, very simple explanation, and learn this explanation while I'm writing it down. The above risk exists because the calculation of loan breakup between current and non-current is highly complex, and the management may have made an error during this calculation, hence misstating the breakup between current and non-current portion. Simple. Got it? That because this calculation is highly complex, because of this risk is existing, that the management may have made an error and calculated the wrong figures for current and non-current portions of the loans. Got it? Any questions? So, what is going to be the appropriate response in this case? That is also a question that you need to answer yourself. Again, learn this point as well. You can give any type of response. If I come back towards the notes, what is the response that I have written here? The audit team must ensure that the split between the equity finance is correct and the total financial produced dash amount were received, disclosures regarding the blah, 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 blah. You can either write this down always, or you can write down an easier one that I'm going to write down here. That is that you as a manager will let your audit team know that go to the management, ask them to provide you how they have to give you an explanation of how they have calculated the split between the current and the non-current portion of the loan. And if the audit team wants, they can do it themselves because they are experts. So they can calculate the splits or in their own working using their own expectations, and then compare it with what has the management recorded. They can calculate the split, the breakup between the current and non-current portion, how the loan should have been recorded between current and
Is it that
non-current
hard?
portion. They can calculate it and then compare it with what the management has recorded. And if there is a difference,
But
yes, come again.
I don't think it's that hard. If it's judiciary, it's current. If it's not judiciary, it's non-current. Is it that hard to split?
Yes. So how are you going to explain it?
No, what I'm saying is, I don't think it's that hard to split between current and non-current loans.
You think
Is
that
it?
it is not hard to calculate the split between current and non-current portion of the loan? Then how are you going to
Nope,
identify
it's
the
not.
risks? How are you going to identify the risks?
I
It
don't
is
think, you know what
not.
I mean? I mean, like, it's not
I
that
know what you mean.
complicated.
I know that it is very
Because
easy
you're
to
saying
do
it's
so.
complex. It's not complex.
It is complex. For you, it is easy. But for the people who are working within the company, it is complex for them. Because you, as an auditor, audit every single day a new company which is taking out a loan. You are expert in this point. You have just studied F7, you know it is not very difficult to calculate the split. But the people who are working in specifically, let's say XYZ company. XYZ company is going to take out a loan once in its life, or maximum thrice in its life. So the people working there are only going to experience this case just thrice in their whole life. So in that case,
Okay.
you are doing it dozens of time every single year, dozens of time. Whereas those people are doing it only thrice in their whole life. Is it easier for you or easier for them? Obviously, it is going to be easier for you. And they might make mistakes in this calculation because they have not done it. They are not experienced in it. Now, do you understand the point behind it? People within company are different. You, as an auditor, you are a different person. You have a different perspective. You have done everything so many times that you are expert in it. Audit?
Yeah.
Great. Now let's write it down. The audit team should recalculate the split of the loan between current and non-current portion and then compare with what the management has recorded. And if there are any differences, these should be discussed with management. 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 That's it. That is the only response always that I'm going to give in the case of a new loan or if the company is issuing equity. So in the case of equity, what would I have write? What would I have written down? The audit team should recalculate the split of the new equity between share capital and share premium, and then compare with what the management has recorded. And if there are significant differences, these should be discussed with management. That's it. Only the words are going to change. The rest will always be the same. Understood? Can I
Right.
move forwards now?
Yes, absolutely.
Great. Let's move forwards towards the next part of the question and how many risks we have identified up till now. By the way, we have identified 3 risks. So we are done. We only need to write down 5 more. I think they are going to be very easy, not that much difficult. We have so much remaining at the moment. The payables ledger clerk has recently discovered a batch of supplier invoices that had been miscoded and therefore had not been recorded at trade payables. This error has now been corrected, but investigations are still ongoing to determine how this happened and whether other batches of invoices have been miscoded. In the
That's a
previous
risk by
question of,
itself.
yes, there is a risk of understatement of trade payables in this case, first of all, because there is a risk that this error has happened in one case and the investigation is not yet complete, and hence the other payables invoices might still be missing at the moment, which have not been recorded right now. They might be missing out. So I think that the case here is same when I compare it with the risk that you identified within the question of Magpie Corporation. But in this case, we are going to write it down. I will write it down here because within the Magpie Corporation question, I did not write it. So let's move towards this risk. This risk is also very easy, just as I have identified. Let's write it down. There is, sorry, why is it bold? There is a risk that the trade payables within the statement of financial position is is understated. That's it. There is no expense linked with trade payables, so forget about it. Do not write down at the relevant expense is understated, or the examiner is going to get really confused. What expense are you talking about? Because no expense is linked with trade payables. Okay. So is there any kind of standard linked with it? Do you remember any type of standard that
Yeah.
is linked with it?
But
Which
then
standard?
but then wait, can you go back to the question?
Yes.
Wait, just 1 second. So if it's not recorded, so how come expense is not misstated?
If something is not recorded, what is happening?
Then it's not recorded. It's not debited or credited.
It's not recorded. This means they should have recorded it, which they have not recorded it. I am saying that some payable invoices must have been missed still, and they have not been recorded, which means that the trade payables is under recorded, which means that it is understated, not misstated. I can clearly see that the trade
No, no,
payables
I'm talking
might
about
be,
trade payable. I'm talking about the expense. The relevant expense.
which is what is the expense within the statement of profit and loss, which is linked with trade payables, by the way.
Every expense, just trade payables.
You don't know what trade payables is?
No, no, I'm talking about you.
Huh?
No, no, I mean like what's trade payables? Obviously it's an expense.
No, it's not an expense. Trade
Yes,
payables is
I
no,
mean
no, no.
it's like you buy something and then you have a
Yes,
payable.
yes. But it is cost
It's
of
an
sales.
expense.
Cost of sales will not be understated. Remember that. Because on one way, remember what is happening right now is this. When you buy something from a supplier, you record it on the inventory side. So we are not creating a risk here that the inventory might be understated because inventory is fulfilled. There is no risk above the inventory. The company may have recorded the inventory. But the case is that when the supplier is sending you the invoice, you are not recording the payables portion. The risk, again, remember this portion that first the inventory would be recorded, then the trade payables would be recorded. We by default as an auditor always believe in this fact that assets are something that the company would do every single thing possible to make sure that they are not under recorded, because that creates a good picture for them. So we are not creating a risk on that side. We are creating a risk at the moment on the payable side. Got it?
Yes.
Great. So that is why I'm not moving towards the expense side, because first of all, no expense side is linked with payables. Inventory is linked with payables. Understood?
Okay.
And let's move towards the second part. Is any kind of standard linked with payables? Under recognition of payables, is any kind of standard linked with it? There is, by the way, no standard link with it, but I know one very small thing about IS 37, a very beautiful standard that is known as IS 37 provisions, contingent liabilities, and contingent assets, which states that
I know it.
yes, if you have bought something, if because of a past event, a future, you will have to, a future outflow of economic benefits will occur, that should be recorded as a liability. That was the definition of it. So instead of mentioning the proper accounting standard, I can also simply write this down. So I will state accounting standards states.
Record as a contingent liability. That's what you're saying.
No, not as a contingent liability, as a liability, because the liability, trade payables are not contingent liabilities, by the way. They are known as liabilities.
But then,
Yes.
okay, let's see what you're writing.
What is the definition of liability?
No, I get it. I just want to see what you're writing.
Okay. Accounting standard states that if because of a past event, a future outflow of economic benefits will occur, these should be recorded as a liability. So instead of specifying the accounting standards, I've written down the basically definition of liability in a way that becomes linked with this specific portion. Got it? Any questions now? Any misunderstanding?
But it is a contingent liability.
What is the definition of a liability? Please let me know this.
If there's going to be future economic benefits, there's an obligation, but right now there's no obligation. There is maybe it's a probable obligation.
What is trade payables? It is an obligation. It is
yeah, but here, but in this situation, it's not like an actual obligation because it says. Can you go back to the question?
Yes.
Because it says whether any other batches of invoice have been miscoded. So there's not like a fully present obligation because the error is already corrected. He says the error. This error has now been corrected, but investigations are still going to determine how this happened and whether any other batches of invoice have been miscoded. So it's like there's no like there's no 100% obligation right now. There's a potential obligation.
Yes, there is a potential obligation that
which is a contingent liability.
Yes. No. In that case, no, don't take it right there that it is a contingent liability. Contingent liability is something else which is dependent upon a condition. There is no condition here. The condition has been fulfilled. You have bought the asset.
There are provisions.
You have bought the inventory from the suppliers. The thing is that there might be a case that you have bought the inventory, but you have not recorded the liability because they were mismatched. That is the risk here. So even if you do identify it, that will not be recorded as a CL, a contingent liability. It will be recorded as a payables. It will be recorded as an obligation. When you identify, in case that you identify that the management may have missed out some kind of invoices, they should have recorded them as a liability. Would you record them as a contingent liability or would you record them as a liability? Because contingent liability is based upon a condition. There is no condition in the case of payables. The condition is always present there. You have bought something from the supplier. Contingent liability is fully something else. In this case, we are not saying that there might be reasons.
Actually happen. So you're not saying that there's actually, you're not saying like payables will have to be actually recorded. It may be recorded. So what you're saying?
No.
Are you like saying management will record payables or they might record payables? Might have to record payables.
They
Then I might
might have
agree
to
with
record
you.
payables because they might have missed out the payables. That is what I'm saying. I'm not saying they might have to record the payables because they might have bought something. They have bought something. I'm saying they might have missed out the invoices.
Okay, that makes sense. But if you see
Yes.
like
Yes, yes.
they have to record the
I'm not saying
payables.
that they might have not bought the inventory. They might have bought the inventory. I'm not going towards that portion. I'm going towards the portion that inventory has been bought. My student has bought this pen from me. He has bought this pen from me. Maybe he has not recorded this payment he has to make me in his payables account. Maybe he has missed that. Now, that is not going to create a contingent liability in the future. You had to record it as a liability which you have missed out. Got it? Understood?
Yes, yes.
Great. Now let's move towards it. So according to this is the definition that I gave. Now let's move towards what are the reasons behind it. Simply, I'm going to state the reason which has been given to me within the question as well. I don't need to go in detail. The above risk exists because the company has identified that they missed invoices within the payables portion, and there might be other invoices which are still missing and have not been recorded as I'm also going to write this down, that as the investigation is still ongoing and not complete. But at the same time, there is one thing else that I can link here. One thing else that I identified within analytical procedures, the trade payables payment period was reducing, which is also evident that the payables have not been completely recorded, because of which your payables periods are decreasing.
Got really good IQ.
You get it now?
Your IQ is 100%. Yeah.
Do you get it? How am I linking the analytical procedures
Yeah, I
with this
get it.
scenario? And you know, if I write this down, the examiner may give me 1+ marks for it, because the examiner has stated within the examiner report that when the analytical procedures are linked, when you perform these types of calculations, you can get 1 extra marks for it. Remember that. So I'll also add it down. And this is also evident from the case that the payables payment period has decreased from, what was the payables payment period in the previous year? It was 64 days to 38 days. 64 days to 38 days, which might show that the payables are not completely recorded. Not completely recorded. You are missing something out. Got it? This is how I created the risk. This is how I linked the, what do you call it, the analytical procedures with this risk, and included it within my answer as well. So one of the analytical procedures has been already linked here. And at that time, within the payables payment period, where I said that there is a risk that the payables might be understated, you were not understanding it. But now linking it with the story, now you understand, okay, this is why they were decreasing. So maybe there is something going on fishy here. Got it? So let's move towards it. What is going to be the response in this case? Because that is going to be very difficult to identify. Can you give me an appropriate response?
Huh?
Can you give me an appropriate response in this case?
Okay, what I would say is let's wait, give me 1 second, let me think.
Think
Check
about
all the
it.
trade payables.
In the exam, you're not going to have this much time to think about it. Think about it clearly on the top of your heart. What comes first to your mind? What should
What
the
was supposed
audit
to my
team do?
mind?
What should the audit team do now?
Increase the
How are they going to
efficiency.
identify whether some invoices are
Inquire with
missing or not?
management to give them like some of I don't know, like their invoices, and then perform sampling on the invoices, and then see if that matches. I don't know. Doesn't
Okay.
even make sense.
50% of whatever you said is correct. Let me clearly phrase it out. The audit team, first of all, what is the question here? The question is, how do you make sure that all the invoices have been recorded within this within the trade payables account. So one way to do it is that whatever the company has purchased during the year, whatever the company has purchased, make sure that you pick out a sample out of those purchases and identify which invoices are linked with those purchases and trace those invoices back towards the payables balance, whether those invoices have been recorded within those trade payables balances or not. Does this satisfy your answer? Does this satisfy your mind?
Makes sense.
Yes, it makes sense. And now let's phrase it more professionally and even more betterly. This was the first answer that I would have written on. But let's come towards a student who has done a lot of practice of audit risk question. How would you write it down? Now see, for example, my year end is 31st of December. Okay, my year end is 31st of December. If I pick out a sample of invoices from 31st of January, obviously the company would have paid it in the mid year. So there is no point in picking out invoices that have already been paid. Which invoices would most probably be outstanding? Which invoices would be outstanding? Invoices that are close to year end. Those are the invoices that would not have been paid at the moment, which have to be recorded as an obligation. Do you understand it at the moment?
No. I don't understand. What do you mean invoice
Okay.
for the year
Again,
and where
again,
that come
again.
from?
Let's say your year starts at 1st of January 2024 and your year is ending on 31st of December 2024. Got it? You are going to record payables based upon what? All the invoices that suppliers have sent you, which you have not paid at the moment, only that are recorded as payables. Am I correct? Invoices which you have paid, those are not recorded as payables. Why would you record something as an obligation which you have already paid? Do you understand this? If I have paid you something, if I bought something from you and paid it to you, am I going to record it as a payable within my financial statements?
No, no.
Obviously, no, because I paid it to you. Obligation is something because of which future economic benefits will outflow. If future economic benefits have already outflowed, there is no obligation anymore to record it. But are you going to record that I have to pay Sir Gohar, let's say 300 pounds of fee for the audit subject in your payables account? No, because you have already paid it. Are you going to show your suppliers that this is the amount we have paid to us? We have to pay to our suppliers if you have already paid it. No, you are going to show an obligation when you haven't paid it at right now. You are going to show it that these are the remaining invoices which we haven't paid at the moment, and those invoices total would be recorded as a payables portion, right?
So you're saying the beginning and stuff, this was might have already been paid.
Yes, yes, that is what I'm saying. So my question is, close to year end, those would be the invoices which would most probably be unpaid, because invoices during the mid of the year which the company has received during the mid of the year, invoices which the company has received during the start of the year, or let's say in even September, August, move backward, July, June, May, those invoices would most probably be paid by the company. So if I am selecting an invoice that was raised in May and the financial statements are made on 31st of December, and I say, is this recorded as a payable or not? Why would it be recorded as a payable? Because most probably it would be paid. Now, if I go to the management and ask them, their answer would also most probably be, look, we have paid this invoice. Why should we record it as a payable? They would not be included as a payable. So which invoices are more probable that they would not have been paid? Those invoices are the ones that I need to select a sample from. Do you understand my point right now? Yes or no?
Yep, I get your point.
Yes. So now I'm going to rephrase my response, and instead of writing this down that during the year, no, I will stay close to year end. Close to year end, identify the invoices that were raised from the suppliers, and on a sample basis, check whether these have been recorded within the financial statements as a payable or not. Now the answer is more better, because now I would be selecting samples from the invoices more probably that have not yet been paid and should have been recorded as a liability, as a trade payables. And if something is missing from that, that is missing at the moment, which should be recorded. Do you understand my point right now? Is there any confusion?
Is this wow? No, it's not confusion.
Okay, great. So my answer is going to be the audit team should select a sample of invoices that were raised from the suppliers close to the year end. And what is the year end, by the way? 31st of August 2015 for this specific company. At I can also write in close to year end, and then trace these invoices, whether they have been recorded as a or payables, and if not, then discuss the reasoning with the management. Understood? Any questions?
No.
Great. Okay. Let me give you this understanding more clearly, because now you have understood this point by why I selected the invoices close to year end instead of selecting the invoices mid year or fourth year. Let's say I select 100 invoices that were raised within January. I select 100 invoices that were raised in January, 100 invoices from January as a sample. Out of this 100, I'm going to trace that are these recorded within the trade payables or not. More probably all of them would be paid, but let's take for example that one is unpaid, and I try to trace it and say, okay, this one invoice has been recorded, 99 invoices have not been recorded within the payables account. Now I will go to the management and ask them, why haven't these been recorded? For each of these 99, most probably the management is going to tell me, look at this, against all of these invoices we have made a payment of 100 million, so why should we record it? Now let's move to the scenario number 2, close to year end, close to 31st of August 2015, close to year end. Let's say I select invoices of July, 100 invoices of July. Now, out of these 100 invoices, I identify that 20 are recorded within the payable section, 80 are not recorded. I go to the management and ask them, why haven't you recorded these? The management will say, okay, out of these 80 invoices, we have made payments for 10 invoices. Because they're close to year end, some of invoices would be paid, and the management would let us know that these have been paid to the supplier. The remaining 70 invoices would not be paid, and those are the invoices that the management is missing at the moment, which are not recorded within the payables portion. Understood? Is the confusion cleared? Because close to year end, majority of the invoices that are raised from the supplier, the management has not yet paid them. They should be recorded as a payables. Great. Understood? Any confusion?
Yes. No.
Great. Now let's move back towards our question, because we have also identified and given the response against risk number 4. Great. We are moving to risk number 4, and we still have a lot of question remaining at the moment. It is going to be very easy, I think, for us to solve everything. Still, I think there is 1, 2, 3, 4, 4 paragraphs remaining at the moment, and we only have to identify 4 different risks now. Let's move on. There was a fire in the South warehouse in June 2015, which resulted in damaged inventory. Okay. I'm not going to write this one down. No, I won't. Why? Because if the inventory is damaged, there is a risk that the inventory is damaged because of the fire, and it will not be able to sell within the market properly, because of which no one is going to buy it. Hence, the inventory is at the risk of overstatement, and the relevant expenses of writing down the damaged inventory within statement of profit and loss is at the risk of understatement. The management may have not recorded them off. At the same
With
time,
inventory,
yes,
haven't
for
this
inventory.
inventory, like obviously, like sometimes I don't know when to use either NRV, when to say it should be it's
Net
obsolete.
realizable
Because
value.
like
What is?
what I'm
Yes.
saying is, like you're saying the damage should be written off. What if it's like should be written at the NRV instead?
What is
Written off
NRV?
is if it's like written off is when you think the inventory is completely done, it cannot be sold, so you remove it completely. But the NRV is like when it's damaged or something happens to it, and you know you people will not buy at a normal price. So
Okay.
then I'm like, which standard should I use?
Okay. I'm going to explain this very clearly. IS2, let's talk about it. Have you studied IS2 within F7?
Yes.
IS2 is the standard that deals with inventories of how you need to record them. There is a very specific line that states that when you buy an inventory, you record it at the cost you bought it for. Let's say you bought an inventory at $100. You record it at $100. Debit inventory, credit either payables or either cash if you have paid for it. So this would be your inventory. And this inventory, if it is unsold at the year end, this would be shown as an inventory within your statement of financial position. Great. Do you understand?
Yeah, I understand that.
Great. Now let's move towards NR. The same inventory, the same inventory. I'm not going to use the name of damaged. I got to know that in the market, this inventory at the moment is also selling for $100. All right. And if I want to sell this inventory, I'll have to pay my agent a fee of $2. So this is the selling price of the inventory. This is the cost to sell this inventory, the $2. So net total, my benefit from selling this inventory would only be $98. This $98 is known as NRV. What is NRV? Net realizable value or net benefit that you are going to receive from selling this inventory. What is the net realizable value made of? Net realizable values formula is selling price of that inventory less cost to sell off that inventory is equal to net realizable value. IAS 2 clearly states that whether you bought it at $100, but if the NRV is below the cost, you must reclassify it upon the NRV, which means that if you bought one unit and it is currently recorded within your statement of financial position in current assets within inventory at $100, you know that the NRV of the same unit is $98. The value, what is the difference right now? How much is the inventory's benefit reducing by? By $2. You should also reduce your cost that you bought your inventory at. It is recorded at $100. This $100 should be not anymore recorded. Instead, $98 should be recorded. Because IS2, and what is going to happen with this $2 difference? You basically, what is going to be the debit entry, debit and credit? The debit would be statement of profit and loss by $2, and the credit would be statement of financial position inventory by $2. So by crediting the inventory by $2 within 100, I'm reducing it to back to $98. And by recording an expense of $2 within statement of profit and loss. What is happening right now? This is something that we did not determine on our own. IS2 states that if the NRV has decreased and gone below the cost, the inventory should now be re-recorded at its NRV. If the NRV is lower than the cost, we do not look at the selling price. We do not look at the cost to sell. We always have to calculate the net realizable value. If the net realizable value is going down, then the cost at which you recorded the inventory at, you have to re-record the inventory at its NRV. So now let's bring in all the technicalities at the moment. What is the technicality number one? For example, you are holding an inventory within your financial statements at the moment, and it is recorded at $100,000 within your financial statements. You have recorded it within the current assets, within inventory, and it is recorded at $100,000. Within the market, you find out that the selling price of this inventory has decreased. What is the risk here? What is the risk here? If the selling price has decreased, this might have also decreased the NRV, and the NRV might have gone below the actual cost. So now the inventory might has to be re-recorded at its NRV, because of which the management may not have done it. And there is a risk that this expense of reducing the inventory cost down to its NRV, that expense is not recorded, under-recorded, understated, and the NRV is overstated because it is not recorded down. This is technicality number one. The selling price in the market is going down. Technicality number two, the cost to sell this inventory, the agents are now demanding a higher fee. In this case, again, the NRV is going to go down. Same is the case here. The management may not have recorded the inventory at its NRV. Now let's move towards the third technicality. What if the inventory is damaged? It is still sellable in the market, but it is damaged. A damaged inventory would have a less selling price in the market than what the original inventory would have been sold at. If the selling price of the damaged inventory is going down, it is sellable. In the question, it must state that it is still sellable at a reduced price. So if I'm going to sell at a reduced price, the price of the NRV of my inventory would go down. Now I need to re-record that inventory right now. I'm not saying that I am going to sell this damaged inventory, but if you are recording this damaged inventory still in your financial statements, make sure that you record it at NRV. And there is always a risk that the management may not have done it. Any confusions? Any confusion?
No, my confusion. Okay, I think you missed my question, Damo, but I understand. I like the explanation was good, but my thing is, you are saying to write off the inventory. I said you don't write it off. You just look out at the lower of the NRV and cost. You must write it off. So the standard you are saying is we should we should write off the inventory, which is calling the inventory obsolete. But here I don't think that's the case. I think it should just be recorded at NRV, not cost.
Okay,
Go
okay.
back.
Is the question saying that they might be sellable? That is my question.
But then the thing is, wait, it says
Read the question right here forwards. An inventory count is
okay, I just read it
immediately
forward.
following the fire identified that inventory costing 1.1 million required to be fully written off. They had to write it off. Now there is a risk that the management may not have written this inventory off. Simple.
Okay, that makes more sense.
Again, do you understand this? So what is going to be my
Yeah.
answer at the moment? My answer will be very simple. There is a risk that the inventory balance within the statement of financial position is overstated and the relevant rating of expense within the statement of profit and loss is understated. Let's move towards the second number 2. IS2 states that damaged inventory, it is not sellable within the market. If not sellable, it should be written off. Let's move towards the point number 3. Why do I think that there is a risk? There is a risk that within the on investigation of the management has stated that it should be written off. Whereas the risk exists because the management may not have written off this inventory, which is again evident from what? From the fact that the inventory days of the company has increased from 117 to 135, which means that some extra inventory is still being recorded within the inventory balance of the company, which had to be recorded off, which has not been done so, because of which the inventory days are also going up. And again, the above case is evident because of this inventory holding period going up. Now, again, I have linked another calculation and analytical procedure with this explanation. Do you understand? Just as I did in payables. Any confusion? Come up.
No.
Hurry up.
No, no.
No. What is going to be the response in this case?
I asking me.
Ask the management simply, have they written off this inventory or not?
Okay.
Let the audit team should discuss with the management that whether they have recorded this inventory that had to be recorded off, whether they have recorded this inventory off or written this inventory off within the statement of financial profit and loss or no. That's it. That is going to be my simple response in this case, because there is a risk that the management might not have done so. So first, let's ask the management whether have they done it or not. Simple. That is going to be my answer. And I can also do this. I can also provide a response, another response that if you want, if you don't think that, oh, sir, this is not a good response, this is just such a small response, I don't like this response. If you want to give a better response, you will get marks for the response number 1. For the response number 2, you can also write down, ask the management to provide you a breakup of the total inventory that is recorded right now, and identify whether the damaged inventory is still being recorded within that breakup of inventory or not. Simple. You can also do this. Any confusion? Any confusion?
No, no.
Great. So it is very easy to write down the audit risk first of all. Let's move towards the next one. So I have identified the 5th risk here as well, which I'm going to write down here. Let's write it down here. The 5th risk was relating to inventory, which is again very easy. Damaged inventory. You have to write it down yourself. DAMAGED. Damaged inventory. Linked with analytical. And against the response, you can provide ask management. This can be also a response. And the number 2 response that you can write down, obviously you will have to explain it yourself. I'm just providing you a better thing so that it is easier for you to write it down. Ask the management would be my number 1 risk point if I want to write it down. Within the examiner, I will only have to write down 1 response, not 2, because that is a waste of time. The examiner is going to give me just 1 marks for the response. So the second response, if I think that the first response is not too great, I can also write down breakup. Ask the management to provide you a breakup of the inventory balance and check the audit team should check whether the breakup still includes the damaged inventory. And if yes, discuss with the management that these have to be written off. That's
Please just write the response, please.
the second response. I'll write it down. The audit team should ask the management to provide the breakup of inventory balance, and the audit team should then check whether the damaged inventory which had to be written off is still being recorded within the inventory balance. And if yes, then this should be discussed with the management that these damaged inventories should be written off. That's it. Great. Understood? Can I move now?
Sure.
Great. So before moving forwards, give me 1 second. Let me check. Okay, this is an easier risk. This is also an easier risk.
It's not an easy risk.
This is also a very easy risk.
It's not an easy risk. I know what you're trying to do.
No, I'm going to find out that if there is a new type of risk which is going to be difficult for you to identify, that is something that I'm going to do. So I'm just reading it very fast. Okay. I found a difficult risk. So we are going to move towards that. We are going to move towards a difficult risk. Let's read this portion, ignore the rest of the ones. During the year, S Corporation was informed by the tax authorities that it was under investigation for a breach of legislation relating to sales tax. Okay. S Corporation has appointed a tax consultant who has advised that there does not appear to have been a breach of tax legislation and has estimated that a fine, there has been a breach, sorry, not there has been a breach of tax legislation. This means that the company S Corporation has breached some kind of a tax law and has estimated that a fine and a penalty totaling 0.6 million will be payable to the tax authorities. The directors do not intend to record anything in the financial statements until the final notification is provided by the tax authorities, which is due to be received on 31st of January 2016, whereas you are currently making your financial statements for the year end 31st of August 2015 and you have identified it before the financial statements have been finalized. It is an obligation that you will have to pay.
Yep.
Your own person that you hired is identifying that you will have to pay it and you're not recording it. If it is sure that there will be a future economic benefit outflow due to a past event, you have to record a liability. Even if the authority is saying that, okay, don't pay us. Even if the authority has not told you that whether you will have to pay it or not, but the consultant is saying that you have breached the law, which was the past event. And because of this past event, you will have to pay this liability in the future, which the consultant has confirmed, your own consultant, you should record it, which you are denying to do so. So what is the risk here? There is a risk that the liabilities within the statement of financial position are understated. By the way, there is not a risk here. Why am I saying that there is a risk here? It is sure that you have to record it. There is no risk here. You have done something wrong. Risk is something where we have to take a chance. Risk is something where we think, okay, there might be a risk. In this case, you have done something wrong. So just like the second risk that I identified, I will write down. The liabilities within the statement of...
But isn't a provision?
Yes. Okay, you can say... Oh, yes, it is a provision. You can also call it a liability or a provision, whatever it is here for you. Relax, cool down. The provision within the statement of financial position is understated. And how do you record a provision, by the way? Now, what is the double entry when you record a provision? Please hurry up. I'm waiting for your answer.
What do you say?
How do we record a provision? What is the double entry when you record a provision?
Provision on expense.
Yes,
provision.
So what you do basically is that you debit the statement of profit and loss provision expense by 0.6 million,
Liability.
and you credit provision liability within the statement of financial position by 0.6 million, and you haven't done the both. This means that also the provision expense within the statement of profit and loss is understated. So first point is there is the provision liability within the statement of financial position is understated, and at the same time the provision expense within the statement of profit and loss is also understated. Got it? Point number two, IS 37. IS 37 states that when due to a past event there is a future economic benefit outflow, a liability or a provision should be recorded. Simply you can say use the same definition. Now let's move towards the point number three. Why do I think that there is a risk? The above risk exists because the tax consultant hired by S Corporation themselves have identified that the company has breached a law, and because of this breach, they will have to pay a fine of 0.6 million. And the company's management has ignored this and have not recorded this, because of which the above balances are understated. That's it. That is the only reason I know. I have no other reason. I have identified the reason from the question itself. What is going to be the response in this case, by the way? Please let me know of the response. What
What
is
do
going
you
to be
say?
the
What's
response?
gonna be the response?
Yes.
Discussing management that has to be recorded.
No, you're
The
not
reason
going to
why they
ask
no
the
no 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 no
management
wait.
why haven't they
Why
recorded.
they
They
did
are
not
not
record it
doing
yet?
it on their own. Deliberately, they are not doing it.
No, ask them why they did not record it and then explain to them they have to record it.
Yeah,
Simple.
now it is a better answer. Now it is a better answer. The audit team should discuss with the management their reasoning for understanding that why haven't they recorded the provision liability and provision expense. And then it should also be discussed with the management the need to write it under the accounting standards, as accounting standard states, blah, 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 that such a provision should be recorded when there is a past event and a future economic benefit with outflow. That's it. Got it? That is going to be my response. Done. Now, so this is going to be the number 6 response, by the way. The number 6 risk that I have identified, and I have not written about it. You will have to write it down yourself. Let's move towards this. What is the number 6 risk? The number 6 risk is regarding provision. That's it. I'm going to give the heading. Now, let's move towards the things that I have left out. From here onwards, the damage inventory has not yet been replaced, blah, 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 blah. You will have to read this paragraph. You will have to read this paragraph. You will have to read this paragraph. There are 3 risks hidden in these paragraphs, and there
Which
might be
one?
some additional risks. There might
Wait,
be
wait,
or
wait.
might not be. I'm not going to
Wait, one
let you know
second.
the number of risks you are going to find out within this question, within these 3 paragraphs. In the previous question,
Which paragraphs? One,
this
two, oh,
paragraph,
these three. Okay.
these 3 paragraphs. The inventory risk, I have already identified the inventory risk. You don't have to write it down. The last paragraph on the first page and the first 2 paragraphs on the second page. Read these paragraphs and please identify the risks and send it to me. And remember, I have already identified 6 different kind of risks. The risks which I have not written about, I need an answer to those as well. Plus, at least I need 3 more risks from you. At least 3. But within these 3 paragraphs, you will be able to find out at least 4 different risks. I don't need 4 risks from you. I need 3 risks from you. Can you do that? I don't care. You have to do that.
You
Got
don't
it?
care.
Because again,
Okay.
this is how you will be able to pass your exam. If I
Okay.
remember, one thing is very sure within the AA exam and AAA exam as well. If the tutor is doing something for you now, if I'm doing the whole question from you for you, it is basically wasted. Whenever you read this last point from now on, 10 years from now, 10 years from now, if you open up the AA book and you read this last paragraph, you will always know that there is a risk here. Always. You're not going to forget it. AA is an exam like this. Any question that you have done, it is wasted. It is not wasted. It is not going to teach you something new. Got it? So do these portions, send me the answer so that I can review it. That's it.
Fair enough.